everyone. This is Shelley Hoffman with PAC-B TV, and I'm here once again with Rob Just. Rob has been on PAC a couple times, giving us, some financial hints and tips and some information. And now with COVID-19, he's doing his best to try and keep us informed of what's been going on with the government and what they're trying to do to help, and just the market in general. So, Rob, thank you again for being here with us today.
Oh, thanks for having me.
So, I'm sure, I'm not even sure where to start as far as, all the changes. I've never seen anything like this before. Not sure about you, but what can you tell us? What is, are we on the up or are we on the down? Do you think we're coming out of it, or it's just going to get worse? And maybe I just threw a lot at you, but.
That's the million-dollar question. Depends who you ask. That's kind of a complicated question, and I'll get to it in a few minutes, but I think it's best to start. What I'd like to do is maybe update as to where we are or how we got to this point. It's been 4 short months. Seems like it's been a lot longer than that, but a lot has happened in 4 months, worldwide, not just here. And the only way I can explain it would be to say it's been historic. None of us, nobody in charge, no politician has ever gone through anything like this. We've never seen anything like this. So I think just a good start, few minutes as to how this all began, where we are now, and then we can discuss, what's it look like for the future and how do we get out of this. Like I said, it's been four short months. This whole thing started in China. And the first cases confirmed in China were December 31st. So that was not that long ago. And considering where we are now is unbelievable. First death wasn't reported until the third week in January in China. The US didn't see their first case until I think it was January 21st. So it was a good 3 weeks after it was first mentioned in China. The end of China, the end of January 23rd, 25th, right around there, the Chinese government basically shut down the city of Wuhan, where the first outbreak started. So it was the end of January is where the first real steps to contain this started. That's when we started to, here in the US, start to kind of put the brakes on things and say, okay, this isn't just the local few cases. At that time, there was about 550 to 600 cases in China. There were about approximately 20 deaths. So it was starting to really ramp up. By the end of January, a week later, there were 10,000 cases and over 200 deaths. At that point, the end of January, the World Health Organization declared it a global health emergency. So in less than 30 days, we were hit with this world emergency. So about that time is where things started to get dicey here in the US. Stock market had been doing unbelievable. We hit our all-time high on February 12th, I think it was. And then from that point on is where it started to go down. We beginning of February, we saw the first deaths outside of China. We had a cruise ship that was quarantined for weeks. That happened in the beginning of February. So it was starting to ramp up. Mid to end February is where it really, really started, going strong. We had our first recorded death on February 29th here in the US. By then, we were up to 88,000 cases worldwide. So, and by then, the stock market was tanking. By the end of February, stock markets worldwide were just collapsing. And at this point, it was strictly, my feeling is we were still strictly dealing with this health issue. Okay, the US hadn't really shut down yet. So the whole first week or so of the market volatility was strictly the panic mode. People just thinking and seeing, well, we've got this illness. We've never seen this virus before. We have no drugs for it. We have no vaccine. We could be looking at millions and millions of people dying. All the experts, the only thing they could turn to was the closest thing, which was, over 100 years ago, which was the Spanish flu back in 1818. where they had 550 million people affected and 50 million deaths. So that's what started getting everything going. And by mid-March, I want to say, the U.S. market had been down about 38%. Okay, so we were looking at a full-blown economic recession, because now the U.S. was closing. China had been closed. We had already been getting reports from Apple. They came out in the end of January and kind of gave us a warning and said, we're not going to deliver our earnings because we can't get parts from China. So China distribution channels were closed, shipping channels were closed. By now, everything was shut down. Airlines weren't traveling. President Trump had put travel restriction on to and fro Europe, because Europe was hit hard. So now, less than a month ago is where we were at the height of it. Panic had set in, like I said, and also the big thing was the shutting down of the U.S. We didn't know how long we'd be shut down for. Here we are now, 7 weeks into it. A lot of people thought, by May 1st we'll be up and running, and the experts kept saying, well, as quick as it came down, it's going to go up just as quick, and we'll touch on that in a few minutes. But since then, the market has rebounded. Okay, year to date, the stock market is only down about 12%. From the 37% that it was down back in March when we were at the low. Very, very volatile. Through this whole time, we were seeing, minimum of 3% swings on up to 13% swings. We had, I think it was in beginning of March, we had 7.6% drop in the market. That had been the largest one-day point drop in the history of the market. 3 or 4 days later, we broke that record. 3 or 4 days later after that, we broke that record. So in the time period of a week to 10 days, we had 3 of the largest point drops in the history of the stock market. So things were crazy. We were in a full-blown bear market, of which the average bear market is about 36 months. Here we're at the beginning. We got to the bear market in 6 trading days. Historical numbers. 6 trading days to lose 37% of our market. So things were just spiraling out of control. We were up to probably the 4th or 5th government intervention, trying to pump money into the system, trying to keep businesses afloat. The end of March, we had the CARES Act, trying to get people money, trying to get money into the system to keep people stable. Just last week, it was announced we had another $484 billion stimulus package that came out for the small businesses. The first $350 billion went really quick. So basically where we are today is the big thing is, in the last 5 weeks, we've had 26.5 million people file unemployment claims. If you factor the 7 million we had out of work before then, total of 33 million, okay, more than the 1929, market crash, 29 to 35, almost 21% unemployment rate right now, highest since 1934, the Great Depression. Now, like I said, yes, the market has rebounded. It's only down 12%. Month to date, the month of April, we're actually up 8%, okay? But we're not out of the woods yet. Just a couple of notes is that the money that the government has been throwing at the system is for a couple of things. Is one, to get the consumer, to get the individual some money. Okay, when everything shuts down with the unemployment, the American people, they lose income and they lose savings. So with the CARES Act, we saw the increase in unemployment as a way to try to get people that income. The stimulus checks were trying to get people the capital, the savings. Same thing with the companies. They lose income, they lose savings. Okay, and so those stimulus packages, every time, back in February 15th, the Federal Reserve cut interest rates to zero. Why? To make money available for companies to borrow from the Fed and then loan out to the consumer, okay, as emergency funds, et cetera, and so forth. Now, in this whole thing, we've been hearing, people comparing this to the 08, 09 financial collapse, the recession of 08. People have always asking is, how does this compare to it? And it's two answers. Economically, it's a lot worse. Okay. It's a lot different. 08, 09 recession was brought on by a financial system collapse. Okay, the banks collapsed. It was heightened by the Shearson Bank bankruptcy. And now, probably for a year before that, the economy had been weakening. 07 started it, but the complete collapse of the financial system, we had never seen it. And it was potentially could have been a lot worse than it was, okay? Because this was the main, heartthrob of the economy, the financial and the banking system. If there was no rescue, then there would have been some drastic long-term effects. Government did the same thing then that they're doing now. They were pumping money into the system. Interesting note is the difference between the two times was back then, it took the government about 3, 4, 5 weeks to start their incentives and their packages to pump money into the system. Some of them weren't until November, when the collapse started in September. This go around, the government has been so much quicker and more aggressive in pumping money into the system. So that's a positive, okay? Now, from an economic point of view, I think this is a lot worse than 08, 09. Okay, we weren't shut down for 2 months. Okay, now going forward, it's a wait and see. Basically, it's a wait and see. I think, the onslaught of the market collapse back in March, I think a lot of that was obviously the uncertainty of what's it going to be, how long are we going to be ramped down for or shut down for. And I think back then the market priced in probably a 2 to 3 or 4 month shutdown. Typically the stock market is 5, 6 months ahead of the economy. It's a good precursor. They're already pricing in what's happening down in September, October, November. So I think the market was ready for a 2 to 3 or 4 month shutdown. If that lingers, if we're starting to see a 5 or 6 month shutdown, then I think, no, the worst is not behind us. So once again, I think it's a wait and see. Now, the other difference between now and then, the positive is we were at a great spot economically before all this happened. Okay, we were at a 50-year low for unemployment. Our financial system and banks were extremely strong back in January. So we could weather this, once again, depending on how long, but at least we had the foundation in place to weather it. Back in 08 and 09, we didn't have that because the recession had been coming on. So that's why I kind of think the two are similar, but they're quite a bit different. I think this is much larger financial and economic impact. Okay, so you have any questions?
No, I'm just listening. Obviously that's the where people are. It's the fear of, are we going to recover from this, and how long is it going to take to recover? Is the government doing us a favor by throwing all the money out there, or are they actually just putting a Band-Aid on it? Those of us that are not in the financial world, we don't really understand as much the impact of what the government chooses to do with the stimulus check. It's nice to receive the money, but I tend to look towards the future. So in receiving that money, if I am one of the ones that does receive it, does that help the economy long term, or is it a Band-Aid? And that's kind of, when you were talking, that was kind of what I was listening for to find
Okay.
out if that makes sense. Do you know what I
No,
mean?
absolutely, absolutely. I'll get to that in a couple of minutes, but I still haven't addressed the, are we at the bottom? Is the worst over? And I touched on that earlier and said, the short answer is, I don't know. Nobody knows. And you really, we through this whole thing, you're always hearing about the curve. We have to get to the other side of the curve, or we have to dampen the curve and whatever. And to answer that question, are we at the bottom? Is the worst over? We really have to look at two curves that I see. This is the virus curve. Okay. Now, are we over that peak? Are we seeing recoveries outweigh new cases? Are we seeing hospitalizations decrease, et cetera, and so forth? And then the other, more importantly, probably, is the economic curve. Okay. The virus curve, I think, is an easy one to answer. I think the numbers show we're on the other side of the peak. We are coming down. Okay. Now, the economic, once again, that's the mystery. That's what I don't think anybody knows. Okay. And I think that answer to that question is going to have to be a wait and see. My biggest fear is that we reboot this economy too quickly. Okay. People are going out of their minds. Businesses are closed. It's very easy to say, okay, we're going to start opening up the economy now. And a couple of states have already done that. Florida opened their beaches 2 weeks ago. Last week, Georgia opened up health clubs, nail salons, beauty salons. Today, they've opened up bars and restaurants. Tennessee just opened up restaurants today. We have Minnesota, Montana, two other states that this week are going to be opening up restaurants, et cetera. Now they're under a set of rules. It's just not just open up the doors and anybody can come in. But I think the next 2 weeks are going to give us more of those answers to those questions, is what's going to happen. And I think we can use these 4 or 5 states as a good test to see how it could be. Okay. I think New York State, because they were hit so bad, is going to be one of the last states to open up their economy. So I think, I'm very, very optimistic. Okay. No question that we're going to get through this. Economy will be fine eventually. But my biggest fear, like I said, is that we open up too quickly, because, you look back through history books, since none of us lived through it, the Spanish flu they had 3 outbreaks. Their first outbreak was not bad. Then they opened up the economy, people went back to work, et cetera, and so forth. Their second outbreak was the killer. Their first and their third wasn't bad. It was the second one. They opened things up too quickly. So hopefully we can learn from that. But I think the big thing is going to be the confidence that the American people have that once the borders are open, it's okay to go out. Just because they say, okay, this restaurant's open, we still may be fearful that, well, there's still cases out there. I don't want to go. So I think a lot of it's going to have to be the testing. I think that's the big issue. Okay. Especially the antibody testing. The more people that we can test to see if they've had this, do they have an immunity? I think then that'll instill that confidence in the American people. A couple interesting, 3 weeks ago, Chile started handing out what they called immunity cards. Everyone who had tested positive for coronavirus got a little card. So they were, as the economy opened up in Chile, they were the first to be allowed, showing their card, to go into restaurants and bars. China is giving cards. Every person in China is getting a card with a barcode on it. And it's got their complete recent history in terms of travel, in terms of health issues. Had they tested positive? When did they? It's got a list of of their tracking mechanism, who they were around, et cetera, and so forth. And they have to show that as the economy opens up in China. Okay. Now, I don't see the likelihood of that happening worldwide. I just don't see the privacy issue being, but maybe not to that extent, but we have to do that in this country to give the American people the confidence to say, okay, I'm going to go to the mall. I'm going to go to eat out at a restaurant. Okay. So I think that's something we're going to have to look at is, what testing is coming up over the next month. The other thing is the drugs. We don't have any vaccines, forget about, because that's going to be a year and a half away. That'll help us in the next outbreak. But I mean the therapeutic drugs. If there are drugs out there where if I get the coronavirus, I can take the drugs and in 4 or 5 days be better, I'm going to have the confidence to go out. For me, yes, if I know if I get it, it's no big deal. I'll be on medication and I'll be better. Then I'm going to go out, potentially expose myself, yes, but I'll go out and do things. The other thing is I fear we're going to see, and it's natural to see this, we're going to see maybe a little bit of a bump up in cases worldwide. And my fear is that everyone will panic when they see that. This has hit the developed countries worldwide mainly. So countries that have higher dense populated cities have a larger travel mechanism. So, the smaller emerging economic countries haven't really been hit because those people are more stationary. What happens if that starts to, show its head again? The Western Hemisphere is starting now to approach the winter season. They could have an outbreak of it. So I just caution that if we do see worldwide increase, it doesn't necessarily mean it's bad. So I think the next 2 weeks will really show us that in terms of, from the economic and the virus, is the worst behind us. From the economic point of view, like you originally, you said a few minutes ago, is that, what's the long-term effect of all this money being pumped into the system? Well, obviously, the easy thing is the federal deficit. Okay, somewhere this money has to come from. Right now they're just printing it all. Now, hopefully, once things pick up, a lot of that money will come back through people buying things, spending money. But what are the long-term effects? Interest rates are so low, inflation is so low, pumping this money into the system, we're probably 2 to 3, 4 years down the road, things start picking up, we're going to see inflationary pressures rear its head. Now, because rates are so low, that's not necessarily a bad thing. Okay. Right now, from an investment point of view, the 10-year treasury note is paying 0.59%. Okay. So interest rates come up a little down the road. It's going to make bonds, the safe haven of investing, more attractive. Right now, they're not. That could be a plus for the stock market. People won't be putting their money into bonds. They're putting them into stocks. The dividend yield on the Standard & Poor's 500 is 4 times the amount of a treasury note. So people will be looking for income, will be turning to stocks, hopefully. The other potential of all this money being thrown into the system is we're probably going to see a slight devaluation of the US dollar. Okay. The US dollar had been so strong, strongest in the world. And once again, the devaluation may be a good thing. It may not necessarily be bad. Okay. It's going to make, export much better. Okay. Now, if we have a devaluation of the dollar, it's going to make U.S. products much more cheaper to buy worldwide. So, like I said, we'll see an increase in exports, hopefully. So, those are just a couple areas that we could see some long-term effects. Now, very long-term, or maybe not necessarily very long-term, but yeah, other things that we could see is I'm really concerned about taxes. All right. Once again, who's going to pay for all this? Are we going to see personal taxes go up again? Are we going to see the reintroduction of the corporate tax rates again? They were cut drastically the last couple of years. Like I just said, the fixed income bonds are going to lose their appeal. The other thing I always look at is that, every time we have a major problem, major issue like this, is that our world looks different after it. We're hearing about the new normal. 9/11 changed drastically travel forever. About in terms of the TSAs and the pre-boarding check, and you never had to show up at an airport 2 hours before your flight prior to 9/11. So the financial collapse back in 08, 09, it changed the banking system. It changed how banks approve for mortgages, et cetera, and so forth. So, every disaster like this, there's always changing. Now, could it be positive? I think so. I think the big changes we'll see is I think we're going to see savings rates increase. Okay. Personal rates, I think, will increase because people are going to want to be more prudent with their cash. They're going to want to have some cash saved up, some investment saved up for something like this to happen again. Same with corporates. I think corporations will be more prudent with their cash and their money. I think a big thing is I think you're going to see countries, once again, because this was a worldwide problem and not just the US, I think you're going to see countries become much more self-sufficient. You're going to see them less reliant on other countries. I think that's definitely in the US. Look at just what's happened over the last month and a half is most 80 to 90% of ventilators and the masks have been imported from China for the past 20 years. They've always come from China. Well, we've seen what happened there. So I think we're going to see global supply chains change drastically. I think the US is going to find ways to produce these things internally, which I think will be positive. The other big thing we've noticed here is that everyone's working from home. All right. I think more corporations are going to see the benefit of more people working from home. It's going to be cheaper for them, less office space. Well, I think an outshoot of that is going to be a potential technology boom, because now technology has to change to keep up with it.
Well, and all those things make sense. And obviously, for time purposes, how do you see that affecting the economy? Because obviously, that's where we're looking to you for your expert is right. The changes that are helping. How does that impact the market and the economy?
Well, I think it's going to be all positive. Okay, because once again, I think if personal savings rates increase, if people save more money, they'll have more money to put into the economy, savings, investments, spending. I think that by countries becoming more self-sufficient, okay, I think the U.S. will be keeping more of those dollars in-house. There'll be manufacturing production will be increasing, so that'll help. Hence, like I said, the technology boom. Okay, so I think you'll see across the board, you'll see the worker become much more productive because of the technology booms. The fact that the interest rates are so low and probably will be for the foreseeable future, I think is a direct correlation to helping the stock market. I think that's why we've seen such a boom in the stock market over the last 10, 12 years since 08, 09. We went through a 10 to 12 year period of historically drastically low interest rates, near zero interest rates. And once again, like I mentioned earlier, people need income. So they're going to start looking to maybe some stocks that pay higher dividends. So I think that'll help also. So I think it's all good down the road for the U.S. economy.
Okay. Well, and that, that all sounds good, because that's like I said, that's the overall fear is, are we doing what we can right now to continue to help the economy long-term? Or are we trying to find quick fixes with?
Yeah, and that's a great point. We could go on for hours for that, but just to comment on that is it's such, I wouldn't want to be in the position of any of these people, politicians or not, making these decisions, because they are tough decisions. And I mean, you hit the nail right on the head. There is a fine line where they have to make decisions based on now versus long term. I look at it as being, it's similar to if someone gets injured and they go to the emergency room at the hospital, okay? They're there to treat why you're there. It may not necessarily be the best thing long term, but let's get this under control. And that's what the government is doing right now. It's triaging the US economy. They have to do something to stop this bleeding. And that's what they're doing. Then once things under control, yes, there's going to be more stimulus, more packages down the road so it won't damage the economy. And some of it may be bad, like raising taxes, et cetera, and so forth. But it's a very fine line between what do we do to keep this economy afloat versus hurting long term.
No,
I think they're doing a good job. We can nitpick here or there, but overall, I think they're doing a very good job.
good. Well, that's good to hear. And obviously, like you said, this is something, and there's a lot of topics we could go on and on for. And I believe that you've talked to PAC-B about coming on a few times to kind of hit these key things.
Yes.
So I definitely look forward to talking to you again in the future. But at least for now, with this episode, and like I said, I'll probably talk to you in the next few days, and we can get some more information.
Yeah, and the main thing I just want to leave on is that investors out there should just, because everyone's always asking, what should we be doing? That for right now, the best advice I can give is stay the course. Okay, history has shown us that a year after a bear market, the market has returned 44.7% return, the 1 year after a bear market. Okay, when that starts, when it ends, we don't know. So stay the course. Okay, and typically what happens is you're going to notice the if you're waiting for the economic good news before you get back in the market, don't just get in now, because typically what happens is the bear market or the stock market does better or starts to go up even as we're still getting the bad economic news. So if you wait for the economic news to get better, you're probably already seen, a good chunk of that rebound. And we've already seen that. We were down 37%. Now we're only down, 12%, 15%. So we've seen some of that, even though there's still this bad economic news coming down. So don't try to time the market. Stay the course. If you're out of it, you may want to start getting in slowly now. But the next episode, we can touch on that.
All right, perfect. So, well, thank you for your time as always, Rob. And if you have questions about what we've talked about today, reach out to PAC-B and let us know. Or if you have specific questions you want Rob to answer for the next episode, message those to us through Facebook. Reach out to PAC-B TV so that Rob knows exactly what the questions are so he can address those. Everybody have a great day. Thanks again, Rob.
Thank you. Bye-bye.